In order to generate our numbers for free cash flow, we're going to have to deal with financial statement data. We need to take a couple of things and recognize them with financial statement data. For one, accounting figures are distorted, and there are a number of reasons that they're distorted. There are rules and there are laws that have to be followed in different jurisdictions. There are assumptions that are made by the accountants in the company, and there are generally accepted accounting principles. And there are sometimes inaccuracies or even manipulations by management. What financial analysis tries to do is to get those numbers to represent economic reality. So we're going to be adjusting for our non-cash expenses, such as depreciation, and we're also going to be looking at the categories of revenues and expenses and trying to just detail out those things which are relevant to the operation of the company. Operating cash flow becomes our basic starting point for all of our valuation efforts, and so we have to truly understand the figures that are being involved, and we have to know how to compute the various milestones that we're going to run into. So our operating cash flow, our net operating profit after taxes, and finally our free cash flow. Let me talk about how to compute EBIT for a moment and refresh your memory. Given a bunch of financial information, how would you compute EBIT? There are two basic approaches. You can start at the top of the income statement and work your way down, or you can start at the bottom and work your way up. Now, EBIT's closer to the bottom than it is to the top, so it's really easier to begin at the bottom, and it's easier to remember from the bottom up. Faced with a set of financial information, if I know what my net income is, and my tax expense and my interest expense, I can take net income and I can add back my taxes and I can add back my interest and I can arrive at EBIT. It's a very simple computation and it's easier to remember than what category do half a dozen items fit into if I'm trying to start with revenue and work my way down. Now, if you are faced with a situation where you're not given net income, you're going to have to begin at the top and work your way down. And so the easy way to remember how to categorize it is if it's not interest or tax, it's somewhere above the EBIT number and would be removed from revenue in order to determine EBIT, provided it's something that belongs on the income statement. When we're building a pro forma income statement, you're going to want to have some sort of a template or a group of labels in the order that they would appear on a normal sort of an income statement, so that you'll know what gets plugged in where, and you're going to use it to compute the milestones on a forecast project. The tax rate we're going to deal with is simply going to be computed as the tax expense the company faces divided by the earnings before taxes, or EBT. EBT is sometimes also called the net profit before taxes. As you've noticed on the financial statements, our author uses a set of labels which are not standard accounting labels. And this is both good and bad. It's good because it has specific meaning to the finance major, which is a little bit more clear. For example, net operating profit before taxes and net profit after taxes. It's going to reflect some numbers that are very clear to the financier, but that's not normally what you see when you're analyzing financial statements. In analyzing financial statements, we're frequently dealing with accounting information, and so we're faced with the gap labels like net income. We have to understand how to arrive at the numbers that we need, regardless of which label we're working with. Second, there's an average tax rate and a marginal tax rate. The average tax rate is what we're concerned with when we're computing our tax rate here. We're going to be looking at what the total tax expense is divided by the earnings before taxes, and it's going to give us our average rate. It's not going to take into account what was the tax bracket the company was in at the end of the year or at any particular point when a project is being considered. However, considering the tax bracket is relevant to a lot of business decisions, and so I just want to take a moment and talk about the marginal tax rate. The marginal tax rate is going to be that percent of taxes paid on the next dollar a company earns. If their marginal tax rate is 40% and their average tax rate is only 34%, 34% is going to be used in computing net operating profit after taxes. But 40% is going to be relevant for figuring out should we or should we not engage in a particular set of activity or embark on a project. Typical tax rates used in finance problems will be something like 34% or 35% or 40%. Nice round numbers, and these come from the marginal tax rates and typical high-end average tax rates that companies face. Now, 34, 35, and 40% are not really true-to-life numbers. What we're going to see in normal practice is that a company is actively trying to manage their tax burden and minimize it. They're going to follow the rules and loopholes available in the tax code in order to come up with the lowest tax burden they can. So frequently in real life we'll see an average tax rate of something like 18 to 22% for a lot of companies. Some companies higher, some companies lower. A few words about depreciation. Depreciation is a non-tax expense that a company uses in order to spread out the cost of a capital expenditure, in order to spread out the cost of a major purchase which was going to contribute value to the company over a long period of years. What it produces for the company truly is a tax deduction. And there are various rules that we follow for depreciation. Straight line is the simplest. We simply take the net value expected of this piece of equipment and divide it by the number of depreciable years that the IRS says that we can depreciate it for. If you have a $1 million piece of equipment with a $100,000 expected salvage value, the net value of that piece of equipment is going to be $900,000. If we are allowed to depreciate it over 10 years, straight line, that would give us $90,000 in depreciation each year. The trouble with this is that it doesn't allow a company to recoup that expenditure fast enough. And so there's something called MACRS that was come out with. MACRS is pronounced MACRS, and it stands for Modified Accelerated Cost Recovery System. What MACRS is going to do for a company is allow them to deduct more of that expenditure earlier on in the life of the equipment, when they're getting the greatest benefit from it. So in MACRS, we're going to see information coming from a table, and there's a particular formula that's used. You're going to use the MACRS table, as shown on the slide in front of you, based on the number of years that the IRS says you can depreciate an asset for. So for instance, if we have a 3-year asset, we've got a particular percent that we're going to depreciate for each year. And you'll notice on the table that for a 3-year asset, there are actually 4 years involved in the computation. What this boils down to is that for each of the 3 years that the asset is declared to be useful, we've got a certain amount of depreciation we're able to take, and that leftover year is going to be whatever hasn't been depreciated. Under the rules of MACRS, we'll be depreciating something completely to zero. There's no salvage value involved in the computation, and that's taken up in that final year of our MACRS depreciation. If we're working on a $100,000 asset under MACRS, we would deduct 33% of that in our first year if it was a 3-year asset. So 33% of a $100,000 asset is $33,000. In the second year, we'd be able to depreciate 45% of that $100,000 asset. We're going to stay with the same base amount each year that we work through our depreciation. 45% of that original $100,000 is $45,000. At the end of the third year, on that $100,000 piece of equipment, we would depreciate 15% of it, or $15,000. At the end of the third year, we would have depreciated 93% of that $100,000 asset. We would have had total depreciation of $93,000. We'd have 7% left over, which we're allowed to depreciate in the fourth year if we depreciate it again. The alternative is we might wind up selling that piece of equipment. If we sell the piece of equipment, we're going to have to figure out, did we have a gain or a loss based on the sales value versus the book value. The book value is going to be the amount that we paid for it up front minus whatever our accumulated depreciation is going to be. If we're working with an asset which has more than a 3-year recovery period, then we'd be looking at a 5-year, 7-year, or 10-year asset. We simply use the percentages shown in the appropriate column. Computing operating cash flow is going to start with EBIT. So our net income plus our taxes plus our interest is the easiest way to compute EBIT. That's the bottom-up method. Failing that, we may have to work from the top down, in which case we might start with sales revenue. And we're going to subtract whatever our direct costs and our indirect costs and our depreciation are. Now, direct costs and indirect costs are usually not labeled as such on the income statement. But on the income statement, we've got labels which will tell us what goes into those categories. The cost of goods sold or cost of goods manufactured are going to be the direct costs associated with a particular business. And the indirect costs are going to fall into the labels that fall underneath that. For example, selling, general, and administrative, advertising and marketing. Those are things that are going to be indirect costs. Typically, indirect costs are composed of overhead, but they always have nothing to do with directly generating the revenue that the company is seeing. The direct costs are frequently not overhead costs, and they will have more to do with the production of the revenue that the company sees. On real-life financial statements, you're going to see that there's usually not a line for depreciation on the income statement. Depreciation is rolled into either indirect or direct costs, depending on the type of business we have. In a manufacturing company, depreciation is frequently found in direct costs, in costs of goods manufactured, and In non-manufacturing companies, it's frequently found in our indirect costs, in selling, general, and administrative, for example. If you're looking at a real-life financial statement and you're not seeing depreciation listed on the income statement, go ahead and look in the statement of cash flows. It will usually be there so that you can adjust your cash flows appropriately for depreciation. The use of variable costs and fixed costs is something we deal with in cost accounting, and it's useful to know there are a number of ratios that we're going to have access to, which are based on the idea of variable costs and fixed costs. However, this is not typically shown under GAAP. And I'd like to point out for a moment that variable costs and direct costs are not interchangeable. Not all direct costs are variable costs, and not all indirect costs are fixed costs. Most of our indirect costs are going to be fixed costs. Most of our indirect costs are overhead, and most of our overhead costs are going to be fixed costs. So those line up pretty well, but it's not a one-to-one correspondence. Similarly, variable costs and direct costs don't have a one-to-one correspondence. There will be some sort of a disconnect between them. But the total costs that a company faces are always going to be the same regardless of how we categorize them. If we're looking at the grand total of costs, it's going to add up to the same total regardless of the categories given. As I said before, we're going to deal with a tax rate which would typically be 34, 35, or 40% in finance problems. And you might be given the percent, or you might have to derive it from the formula, the tax divided by the earnings before taxes. To compute net operating profit after taxes, we'll figure out what our EBIT is and multiply it by our tax shield, so 1 minus whatever that tax rate is. To take a look at financial statement information, let me just refresh your memory about the financial statement. We've got sales revenue at the top line, and then the bottom line of the income statement is typically net income. Our author does not necessarily do this way. He gives the financier's version of an income statement. So we have net profit after taxes, the $180 figure that's shown on this income statement. That's equivalent to our net income. He then goes through and takes out preferred stock dividends and computes earnings available for common shareholders. He has his reasons for doing this, but what it does for you as a finance student is it gives you a more complicated set of financial statements to deal with. When we're dealing with our operating cash flow, we're going to want to start with net profit after taxes, the $180 figure that I would label net income. Most companies do not have a significant amount of preferred stock dividends being paid out, and as a result, while it's good for illustrative purposes under certain circumstances, what the author is doing is he's giving you what looks like a second bottom line. So make sure when you're computing these numbers that you don't make the mistake of going all the way to the bottom of his income statements, but you're looking for the thing which is going to be net income or net profit after taxes. The balance sheet that the author uses tends to be pretty standard. You have 2 years side by side with a section for assets and a section for liabilities and shareholders' equity. And the total assets still equals the total liabilities plus shareholders' equity. So our formulas still apply that we learned in accounting to this balance sheet. And the statement of cash flows has the usual 3 sections on it: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. And it gives a reconciliation of the cash provided by the operations of the company overall contained in the info from the financial statement here. To compute operating cash flow based on the information the author is giving us in the text, we're going to be working with his version of the income statement. So if we're looking for EBIT, he does have that labeled clearly. We have earnings before interest and taxes labeled about halfway down, and the amount is $370. He's given us our tax rate of 40%, and if you want to double check that, it would be the tax expense divided by the net profit before taxes. So the $120 tax expense divided by the $300 net profit before taxes works out to 40%, so we've got to check on that. The EBIT times our tax shield is going to be the 370 times 1 minus the 40%. So 60% of 370 is $222. To get to the operating cash flow, then we would add back our $100 depreciation and come up with a total of $322. Depreciation is shown on this income statement. It's about the 5th line down, showing up with the $100 figure. Again, if you don't see depreciation on the income statement, you can look on the statement of cash flows to find it.